Economic indicators like CPI, PPI, and GDP are quoted constantly, yet truly understood by very few investors. Most people consume these numbers as headlines. Inflation is up, growth is slowing, the economy is strong or weak. Markets react sharply, commentators speak confidently, and portfolios move. But treating economic indicators as verdicts rather than tools prevents investors from using them correctly. CPI, PPI, and GDP are not answers. They are lenses, each showing a different angle of economic reality, and when misread, they create more confusion than clarity. The first mistake investors make is assuming these indicators describe the economy as it is. In reality, they describe the economy as it was. All three are backward-looking, revised over time, and shaped by methodology choices. This does not make them useless, but it does mean they must be interpreted with humility. Professionals do not ask, "What does this number say?" They ask, "What does this number change about expectations, behavior, and policy going forward?" Let us begin with CPI, the Consumer Price Index. CPI measures changes in the prices consumers pay for a basket of goods and services. It is the most widely cited inflation gauge because it directly affects cost of living wages, purchasing power, and political pressure. When CPI rises persistently, it signals erosion of real income and increases the likelihood of tighter monetary policy. When it falls, it suggests easing pressure on households and policymakers alike. But CPI is often misunderstood because it is not a single clean number. It is an average across categories that move very differently. Housing, energy, food, services, and goods each have distinct drivers and timelines. A falling headline CPI can hide sticky services inflation. A rising CPI can be driven by volatile energy prices rather than broad demand. Professional investors look beyond the headline and ask where inflation is coming from and whether it is spreading or narrowing. Direction and composition matter far more than the absolute number. PPI, the Producer Price Index, sits one step earlier in the economic chain. It measures price changes that producers receive for their goods and services. PPI is often viewed as a pipeline indicator for CPI, but this relationship is neither immediate nor guaranteed. Companies do not always pass higher costs to consumers, especially when demand is weak. Sometimes margins absorb pressure. Other times, costs are passed through with a delay. This is why PPI is most useful when combined with demand indicators and margin behavior, not when viewed in isolation. Professionals watch PPI to assess cost pressures, supply chain stress, and potential margin compression or expansion. Rising PPI alongside strong demand suggests pricing power and inflation persistence. Rising PPI with weak demand suggests margin risk and slower growth ahead. Falling PPI can indicate easing supply constraints or demand slowdown. Again, the signal lies in context, not the number itself. Then there is GDP, Gross Domestic Product, the broadest and most misunderstood indicator of all. GDP measures the total value of goods and services produced in an economy. It is often treated as a scorecard of economic health, but it is an imperfect one. GDP can grow while living standards stagnate. It can contract briefly while employment remains strong. It can be boosted by inventory buildup or government spending without reflecting sustainable private demand. Investors who treat GDP growth as a direct proxy for market returns are often disappointed. What GDP does well is provide a framework. It allows investors to break growth into components: consumption, investment, government spending, and net exports. Understanding which components are driving growth tells you far more than the headline rate. Consumption-driven growth is different from investment-led growth. Government-supported growth behaves differently from private sector expansion. Professionals read GDP composition to understand durability, not momentum. Another crucial point is how these indicators interact with policy. CPI heavily influences central bank decisions. PPI influences corporate margins and pricing behavior. GDP shapes fiscal choices and long-term confidence. Markets react not to the data itself, but to how the data alters the expected path of interest rates, liquidity, and earnings. A bad GDP number can be bullish if it signals policy support. A good CPI print can be bearish if it reduces the likelihood of easing. Indicators are inputs to expectations, not judgments of good or bad. Behavioral traps are everywhere here. Investors often anchor on single releases, ignoring revisions and trends. They confuse volatility with signal. They react emotionally to surprises rather than structurally to shifts. Professionals, by contrast, build narratives slowly and update them reluctantly. They care less about beating consensus and more about understanding regime direction, inflationary or disinflationary, expansionary or contractionary, tightening or easing. Perhaps the most important discipline is recognizing what these indicators cannot do. They cannot time markets precisely. They cannot predict short-term price moves reliably. They cannot eliminate uncertainty. Their value lies in framing risk-shaping scenarios and preventing surprise. Used this way, CPI, PPI, and GDP become stabilizing tools rather than sources of stress. As with all economic data, the danger is not ignorance, but overconfidence. Investors who believe they understand inflation or growth often stop listening when conditions change. The economy evolves. Measurement evolves. Interpretation must evolve as well. The goal is not to be right about every print, but to remain aligned with the broader direction of pressure and policy. And once this foundation is clear, the next step is learning how to read these indicators together, how to detect turning points versus noise, and how to translate macro signals into portfolio awareness without falling into the trap of constant reaction, which is exactly where we need to go next, by examining how to read CPI, PPI, and GDP together as a coherent system, rather than three isolated headlines, because economic indicators only gain meaning in relationship to one another. The first discipline is sequencing. CPI tells you what households are feeling now. PPI tells you what businesses are dealing with beneath the surface. GDP tells you what the economy has already produced as a result of past decisions. When these three move in alignment, signals are clearer. When they diverge, that divergence itself is the signal. Start with the inflation chain. Rising PPI, followed by rising CPI, suggests cost pressures are being passed through successfully, usually because demand is resilient. This environment often supports revenue growth, but threatens margins if pricing power weakens. Rising PPI without rising CPI signals margin compression ahead, a warning for corporate profits, even if headline inflation appears benign. Falling PPI followed by easing CPI suggests disinflation is working its way through the system, often easing pressure on policy and interest rates. Reading CPI without PPI is like watching symptoms without understanding the cause. Next, place GDP into that inflation context. Strong GDP growth alongside easing CPI often reflects productivity gains or improving supply conditions, a constructive environment for risk assets. Strong GDP with accelerating CPI suggests overheating, increasing the probability of policy tightening. Weak GDP with falling CPI can indicate demand destruction, raising recession risk, but also increasing the likelihood of policy support. Weak GDP with stubborn CPI is the most uncomfortable combination, often referred to as stagflationary pressure, where both growth and policy options are constrained. GDP alone does not tell you which regime you are in. CPI and PPI complete the picture. Trend matters more than prints. Professionals focus on direction over multiple releases rather than reacting to 1 month's data. Inflation that is slowing gradually is different from inflation that is collapsing. GDP that is decelerating gently is different from GDP that is contracting abruptly. The slope of change often matters more than the level. This is why revisions are important. When revisions consistently move in one direction, they reveal that the initial narrative was incomplete. Another critical skill is separating cyclical movement from structural change. CPI spikes driven by energy shocks behave differently from CPI driven by broad services inflation. PPI changes caused by supply chain normalization differ from those caused by labor shortages. GDP growth driven by inventory accumulation is not the same as growth driven by private investment. Investors who understand these distinctions avoid overreacting to data that looks dramatic but lacks persistence. Policy interpretation sits on top of this framework. Central banks respond primarily to CPI trends and labor conditions, but they are constrained by growth realities reflected in GDP. When CPI cools, but GDP weakens, sharply easing becomes more likely. When GDP holds firm, but CPI remains elevated, policy stays restrictive longer. Markets move on changes in expected policy paths, not on whether data is good or bad in isolation. This is why the same CPI number can trigger opposite market reactions in different contexts. The final discipline is knowing how to use these indicators in portfolio decisions. They should inform risk posture, not trigger constant repositioning. When inflation pressures ease and growth stabilizes, risk tolerance can increase gradually. When cost pressures rise and growth weakens, caution is warranted. These are adjustments at the margin, not all or nothing bets. Macro data shapes the weather. It should not dictate every step you take. In the end, CPI, PPI, and GDP are most powerful when they reduce surprise rather than create urgency. They help investors understand which forces are strengthening and which are weakening beneath the noise. Used correctly, they anchor expectations, temper emotion, and support disciplined decision-making. Used incorrectly, they become a source of whiplash and overtrading. If this discussion helped you see economic indicators as a system rather than a scoreboard, consider subscribing to stay with these long-form conversations that emphasize context over reaction, and leave a comment sharing which indicator you tend to overreact to most, because awareness of that habit is often the first step toward using data as a guide rather than a trigger.